Hey there, thanks for joining Mortgage Made Simple with Peter. Today's topic, I want to talk about PMI, private mortgage insurance, pros and cons of actually having private mortgage insurance. A lot of people decide they want to avoid it like it's the plague, but it's really not that bad. It has a lot of benefits. It's helped a lot of homeowners get into a home, buy for the first time, rather than waiting and accumulating for years to get that 20% down. Everyone's probably told you avoid PMI, but what if I told you avoiding PMI would cost you thousands of dollars? Let's break down PMI and what it really is and actually how to use it as a strategy. PMI, what does it stand for? Private Mortgage Insurance. It's an insurance that protects the lender from you defaulting because you didn't put 20% down. It's not a bad thing. Again, it's an insurance. It protects the lender. Some of the pros of PMI. It allows you to buy sooner, as I mentioned in the beginning. It keeps more cash in your pocket. You could save up for other things like your closing costs, the moving expenses, an inspection, an appraisal, things of that nature. Furniture that's going to come up for the new home. It allows you to start building equity. Property values are going up. I'm sure you've seen it in your local area, local town, local states. And equity in homes are rising, values of homes are rising. So the sooner you can get your foot in the door, the sooner you could buy a home, the sooner you could capitalize and get that equity in your home and see your investment build in value. And PMI is not going to look so bad at the end. PMI is temporary. As soon as you get to 20% equity, or in some cases it may be even 22% threshold based on your amortization schedule and paying down your mortgage, you'll see that eventually the PMI could just fall off. In other cases, you may just want to call whoever is servicing your note and ask them what the procedure is. They may require an appraisal to be done just to double check what the value is versus what your current mortgage balance is. And like I said, in other cases, it may even fall off because it's all based on your amortization schedule, 7 years or whatever it's going to take, 9 years, 10 years into it, and you reach that 22% equity, the PMI will drop off. Now let's go over some of the cons of PMI. I mean, it's not always the best option, but again, it is an option and it definitely helps a lot of clients. PMI adds to your monthly payment. Obviously, it could be depending, again, there are some factors as far as what the mortgage insurance is going to be based on your credit score, based on how much you did put down. Was it 3%? Was it 5%, 10%? That's going to fluctuate as far as what the factor is calculating that mortgage insurance payment. So, it could be as low as $30 or as high as I've seen, $200. So it could add more to your mortgage payment. Mortgage insurance doesn't benefit you directly. Again, it's protecting the lender in case you default on the loan. And it could feel like wasted money. If you're really close to getting there to the 20% down, maybe you only had enough for 15% down, does it really make sense to carry that PMI? Looking into other options. You're only going to be living in the home for a few years. So again, what's the benefit of having or paying for that PMI? It may make more sense to get to that 20% equity because it's going to be a short-term situation where you're living or where you're going to live, the home that you're purchasing. So what's the real question? Should I avoid PMI? I say no. Because again, if you're avoiding PMI, it may cost you a year or two to save up that money. You may not have the benefit of having a family member gift you money for the down payment. So if you're waiting a year or 2 or 3, again, you're missing out on thousands of dollars in values, property values going up, and building that equity in your home. Also, you're taking the chance of interest rates may change. They may be going up, and you just missed out on a lower interest rate. And while you were building up, saving for that equity, you missed out on a low interest rate. That could cost you quite a bit. So overall, it could cost you, and you may end up paying a lot more overall. Who does PMI make sense? Who does it benefit? You don't want to wait years to buy. That would be one of them. You have stable income, but limited savings. That could be another reason why PMI would make sense for you. And you want to get into the market quickly. You don't want to wait. You don't want to miss the boat. You want to get in while the iron's hot. So again, every situation is different. So talking to an expert like myself that's been in the industry for many years to review the differences, review if having PMI makes sense for you or not paying PMI. There's also strategies, other options to avoid paying PMI and still not having to put 20% down. You can buy out the private mortgage insurance. You can pay a portion of it and reduce the monthly mortgage insurance. So there are other options, even if you don't put the 20% down, to avoid that PMI, reduce that PMI, or eliminate that PMI, and still put a low down payment of 3 to 5% down. Just reach out. I'm here and I'm happy to help you out in any way that I possibly can. Make sure to subscribe and hit the like button, share this, and I'll see you next time on my next video. Thank you.